This is really an interesting time. Again, I've been in this business 20 years. I've traded through a bubble, traded through a bust, strategist through a bubble, strategist through a bust. And the catalysts, they evolve, they change over time. And what becomes really interesting now is we had this great economic recovery coming out of the crisis. And the previous crisis, I was bearish in 2007 going into it. I got bullish in late 2008 coming out of it, and stayed bullish as a strategist until I went to the buy side. And then the last couple of years I've been more bearish because I see things that are imbalances that I'm uncomfortable with. Perfect example, you have, ideally when you have recovery, you want things like economic data slowly trending up. You don't want going too fast because you don't want crashing again. You want slowly trend. You want earnings trending up, recovering, right? You want stock prices trending up, recovering. I mean, I'm of the school, you don't want this bubble bust environment that we've had, right? I've been in this business 20 years. I've witnessed two 50% downturns in the S&P 500, right? And they were witnessed in my first, 12 years or so, 13 years. So my fear is, okay, are we due for another large 50% correction or not? Obviously, the number of years and the timing doesn't have much to do with the fundamentals. It just shows you, cycles play out over time. My concern is this economic cycle is it's getting very long in the tooth. It's been going on for 7 years. This bull market that we've had in equities is the second longest one in history, right? And you're talking about what's amazing now from my perspective and where I sit. And if you look at the fundamental data, from 1960 to 2000, the U.S. economy grew about 3.3% per year, right? From 2000 to today, it's grown sub 2%. From 2000 to 2007, before the last bust, it was about 2.5%, maybe 2.75%. The whole point is the rate of growth of the U.S. economy it's slowing down. So this is probably the slowest expansion or the slowest period of growth, ex a recession or depression in our country in history, right? So then you sit there and say, well, if we're growing slower than we've ever grown before during expansion, well, how much, what type of multiple do you want to pay for the market or stocks in that type of environment, right? Traditionally, the long-term historic PE for the S&P 500 is between 15 and 16 times, and that goes back to 1871, right? So that's what everyone kind of is always measuring the investing environment against. And now a PE is really a moving target because during the 70s, when we had very high inflation, you had very low PEs, right? Today, we have a very low inflation environment, so we have very high PEs. And you're really trying to gauge, well, how high is acceptable? Typically, north of 20 is not acceptable. When we hit our bubble peak in 2000, it was 27. But honestly, that was largely driven up by a handful of large cap technology names that once you take those out, the multiple is actually closer to 20, right? So, and you're basically trying to contrast different environments, one versus the other, to see, where the current valuation fits. So you could sit there and say maybe we deserve a little bit of a higher multiple because we have less inflation and low rates. But the other aspect is we've had all types of central banks, central bank accommodation in the form of easy policy, but also in the form of buying assets. So, global central banks have taken $8.5 trillion worth of assets off the financial markets in the past 7 years, right? Now to think about that, the U.S. stock market at its bottom in 2009 was about, I'm going to say $6.5–7 trillion. So when you think about how many trillions of dollars of assets that have been taken off the market, obviously there's a supply and demand issue there, and that obviously the central banks have taken the supply of the less risky assets in the form of treasuries and sovereign bonds and forced investors to go find more risky assets to invest in. And there was a place to do this, and it's understandable to do that in 2009, 2010, coming out of the crisis. When you're doing it in 2013, 14, obviously in the case of Japan and Europe, 14, 15, 16, well, maybe you've been going too far. Maybe you've taken a step too far. And obviously the ECB and the BOJ have gone to negative rates, which is hurting their financial industry, their banking sectors in both those regions. And again, there's signs out there that maybe it's gone too far. When you come back to the U.S. market, what we've seen is our earnings, which were on a healthy rise off the 2009 low, peaked in 2014. And basically, as we look to start normalizing policy and the BOJ and the ECB became more aggressive, the dollar strengthened, and that created a peak in our earnings cycle, right? And I suspect that 2014 peak in earnings will probably hold for some time. So then, what you have here is now we just hit new all-time highs in the S&P 500 yesterday. So we're hitting new all-time highs with earnings going down. So this is a divergence that's occurring in the market that becomes very risky because of earnings continuing to decline. If our economic data, that also peaked probably in 2014, has been, like jobs have been decelerating, things like that. If we can see continued deceleration there, well, all of a sudden you have the equity market going one way, the earnings and the fundamental data going another way, and that creates a major risk. Now, what do investors do in an environment like this? I counsel my clients to be as defensive as you can. Now, some hedge fund can go to cash, a hedge fund can short. It's not even like shortings. You can short some things, but it's not even a sound strategy at the moment because we're in a bubble and we're so disconnected from the fundamentals that normally drive things that if you don't understand what's going on in the environment, it's hard to analyze. It's hard to make it a good decision. So it's more about being defensive and having low net exposure, low gross exposure, and being defensive. Now there will be people who want to continue to play and participate because the market's going up, and they feel they need to investors don't pay you to hold money in cash or to be very defensive. But if you believe there's a large scale of, there's a lot of risk out in the environment, then your job is to protect your investors' capital. So that's the balance that managers have to go through in an environment like this, because it's a very risky environment. When you have this bubble-like environment, when they turn, they're hard to pinpoint. It's hard to know what the catalyst is. It's usually not an event like the Brexit vote. In 2000, basically, investors, technology, you just hit a point of buyer exhaustion that they pushed stock prices too high that people, when they started to correct, people stopped buying or the people what the first dip got run over and they stopped buying the next one, and then they looked for other areas to invest in, and that led to, that wound up being the peak in the market. In 2007, 2008, there was a little bit different scenario where financial companies were over-levered. They were over-levered. They had bad balance sheets. They had too many bad investments. The problem is in expansion, you don't see that as it's occurring until some damage emerges. So my expectations in the current environment we have today is, I'm sure there's been a lot of bad behavior that hasn't come to the front yet. You just don't see it on a day-to-day basis.